interesting choice of chair to the left of the curve. How are you, Dr. Summers?
I am very glad to be here. It's been several years since I've had a chance to visit Dubai, given COVID and all of that, and I've been here long enough to sense the tremendous economic energy.
I mean, this city is,
here.
this city and this country is quite literally on fire. There's a redomiciling of wealth and a redomiciling of capital. You've packed the high side, so we're not going to waste much time. We want to get the value out of you when we have you on the ground. The great debate in this room and for most investors around the world is where we are in the cycle of peak inflation, peak Fed, and is there any sign of a pivot? Over the weekend on Wall Street Week, you said that you thought that the bulk of the big moves from the Federal Reserve were behind us. I'm just wondering what that means in terms of a pause from the Fed. Let's set the stage, first of all, in what you mean by the bulk of the big moves are behind us.
If you looked at option markets 12 months ago or 18 months ago, they were saying that the odds that interest rates would be where they are today were in the range of 4 in 1,000. So we've had a massive shock relative to what markets were expecting. I was saying a year ago that I thought inflation was going to be much more serious than the consensus, and that the kind of judgment embodied in the Fed's dot plots was way, way off. I don't have any similar sense today that there's going to be a massive shock relative to the consensus. We have seen a very substantial upward move in interest rates. My read is that with respect to the prevailing market consensus, which points towards rates peaking at 5, I think it's more likely that the ultimate figure will end up significantly higher than that it will end up significantly lower. But there's very substantial uncertainty. My best guess would be that there's going to be a bit more momentum in inflation than is now priced in. I think people have a tendency to always pick out the factors in the figures at any moment that are pointing towards transitory inflation, that are pointing towards an acceleration in inflation. To take just one example, the way in which the PCE deflator that the Fed focuses on, their preferred price index, is constructed means that automatically when markets go down, financial services costs go down, and that shows up as deflation because 40 basis points or whatever the asset management fee is shows up as a lower dollar price, and one doesn't expect that to continue as rapidly over the next year as it has over the last year. So my sense is that there's going to be a bit more inflation momentum than is priced in, and therefore my guess is that rates will end up somewhat higher than is now priced in, but not the kind of massive shock that we've seen in the last year.
So what happens if we cast our view forward and we go into next year? I wanted to put it to you that the only way is that not that the Fed blinks, but that the government blinks, because you need to create, unfortunately, higher unemployment than we have to deliver a disinflationary environment or to break the back of inflation. So how far do we see unemployment rising to deliver a disinflationary pulse?
So, I have said many times that unfortunately I suspect that what Samuel Johnson said about second marriage is true of soft landings. They represent the triumph of hope over experience. And so I don't think we are likely to succeed in achieving substantial disinflation without a meaningful increase in economic slack as a concomitant of the disinflationary policies. The latest dot plot's judgment that inflation will come down to 2, with unemployment peaking at 4.5, is a possibility, but it wouldn't be my central tendency in terms of what I would expect.
But to take,
I don't think there's anything that requires unemployment to look like it did after the great financial crisis or as it did during the massive Volcker disinflation of 1980 to 1982. I think the kind of recession that the economy suffered after the NASDAQ bubble broke, or the kind of recession that it suffered in wake of the various strains in the post-1990 period, is probably more indicative, and that would point to an unemployment rate perhaps approaching 6. There's a proposition in U.S. macroeconomics known as Somm's rule, after the former Federal Reserve economist Claudia Somm, which suggests that when the unemployment rate has risen by 0.5%, historically it's risen by more than 2%. That would support a similar kind of conclusion.
What does 6% unemployment in 2023 mean for the economy? Mortgage rates are at 7%. We're already beginning to understand what the lag effect is in terms of the housing market. But what would an unemployment rate of 6% with the savings that we have, or the backstop that we had going into this from COVID?
Look, I think in some ways the unemployment rate is the best single descriptor of how serious a recession is. I think an unemployment rate of 6% would probably mean that we would have a number of quarters of negative GDP growth. But again, we're not looking at something that is of the scale of what we saw when COVID struck, or of the scale of the great financial crisis, assuming that there are not new very large shocks. And of course, there are risks of geopolitical shocks. There are risks of shocks coming from the oil markets. I think you heard my friend Nouriel Roubini earlier, and he didn't get the nickname Dr. Doom for his optimism. So
no, but if you call a recession every year for 5 years in a row, you eventually get one.
So you've been exposed to a perspective on the various risks. But my own view would be that the base case is probably does have to be at this point for recession, given the overheating that the economy has suffered, but it doesn't have to be for some kind of catastrophe.
Okay, so you're not projecting a catastrophe, as you say. The debate, we had it in the green room. By the way, Nouriel Roubini thinks we're going to have a very hard landing. That'll be the shock headline from the green room. The debate that you and I just touched on, you said to me, Manus, I want to talk about the risk of secular stagnation returning, and I said, Dr. Summers, what about financial repression? Do we need that to inflate our way out of the debt? It's 290% in the United States of America, a little bit higher than it was in the GFC. So, Dr. Summers, secular stagnation or financial repression? The choice is yours.
I'm not sure either of those things. I suspect that interest rates are going to be higher over the next 5 to 10 years than is currently priced in. In part, that's because I think there's more risk that inflation, considerably more risk that inflation will average over 2% than there is that inflation will average below 2% in the United States, given where we're starting from, given increased risks on the supply side, given increasing pressures coming from the labor market. In part, that's because I'm not sure we're going to see quite as low real interest rates over the next decade as we have in the last decade. While some of the pressures for low real interest rates, the demography, relatively slow growth, low-priced capital goods, high levels of inequality are still going to be operative, my read would be that a higher level of government debt operates to push up normal real interest rates, and the combination of increased resilience investments. If you have to build two of everything to make sure you're resilient, then capital investment is going to be much greater. And energy transformation investments, those two things are going to operate towards higher investment relative to a pool of saving and to higher normal levels of real interest rates. So my guess is the Fed's next revision on neutral interest rates will be upwards rather than downwards. And if you have to be above neutral interest rates in order to bring inflation down or to hold inflation down, I'd be looking for somewhat higher real interest rates than we've become accustomed to over the last decade.
But it's also about educating groups of investors, the marketplace, economists, to a new higher neutral rate, something that we need to shift our mind to. What is that in your thinking? Where is the new neutral rate?
You know, journalists like you always like to get people like me to give specific numbers so you can write a little story.
You can give me the bandwidth.
Cuts out all the qualifications and have something to run with. And people like me tend to prefer to keep the conversation a little bit more qualitative. I guess what I would say is that I think we're likely to come out of this period with debt to GDP ratios 40 or 50 percentage points higher than they were before, and somewhat larger deficits. And then I would say that a rule of thumb would be that each point of debt to GDP raises real interest rates by 2 or 3 basis points. And that plus the resiliency investments plus the energy investments could lead one to think that wherever neutral real rates were before, they might be 100 or 150 basis points or even slightly more than that higher going forward. Now, it's also possible that the trends that were reducing neutral real rates will continue. So I don't have high conviction, but I think there's probably more room for surprises in the direction of high neutral real rates than for surprises in the direction of lower neutral real rates. And while I've got some concerns about the mechanics of Treasury markets, I don't think that given the really quite low share of taxes in GDP in the United States, given that leverage in the household sector, I think properly measured, is not especially elevated at this point. Leverage in the corporate sector is raises concerns in some limited sectors, particularly around some private equity deals. I don't think that the magnitude of debt problems is such that I would expect there to be substantial pressure towards financial repression. I also think in a modern world of more open and more sophisticated financial markets, even if governments were to desire financial repression, it's a more difficult thing to carry out than has been the case historically.
I suppose that who blinks first. I should say to the audience, we have a couple of microphones roaming around, so it's not all about me, even though Dr. Summers might think it is. There's a hand up. Let's try and get some questions in, Larry, from the audience. There's a young lady here. If we can get a microphone to her, forgive me. Before we go to that, just on that, you are talking about higher debt to GDP, higher debt ratios, et cetera. Larry, the question that goes through my mind, looking at the liquidity in the bond markets, is I had lunch with somebody yesterday that traded bonds like Billio in 1994 at Warburg's, and he said, you know what, Manny, ask him, is there a risk of a buyer's strike again in the Treasury market, as we saw in 1994? Given the debt scenario you've just laid out, given the risks that you've just laid out, do you think there's a risk that there could be a buyer's strike as we saw in 1994 in the Treasury market?
So look, something one learns doing this is that the answer to all questions, is there a risk of, is yes. Because why would you say no? If you say no,
what is it, a more
if
real?
You say that if you say no and it doesn't happen, you've been stupid. And if you say yes and it doesn't happen, then isn't it lucky you were attentive to the possible risk? So if you ask me, is there a risk? I think my answer would be yes. If you ask me, is it a substantial risk? I guess it depends on what you mean by a buyer's strike. If you said, is there the possibility that there'll be a week when rates go up by 50 or 60 basis points? Yeah, I think there is a possibility of that. Is there a possibility that in some sense the United States will be worried that we'll have an auction and nobody will come, given the nature of the alternatives to treasuries? I don't see that as a very substantial risk in the current policy environment. If people want to go on strike with respect to treasuries, they have to go into something else. And I don't think that, Europe, if I think about Europe, Japan, China, crypto, none of them look enormously attractive to me as a medium term place to put value. So I think the United States has very substantial capacities, and therefore, could there be a period of illiquidity? Yes. Could there be a period of forced margin selling that caused instability? Yes. But if you ask me about a buyer's strike, that would be some distance down my list of things to be worried about.
And of course, the bond market structure is completely different to 1994 in terms of market makers and bank balance sheets. Okay, hands up and microphone. Let's get to the audience. If you can stand up, say who you are, and pitch your question to Dr. Summers. Surely we have more than one person with their hand up in this audience. We have one at the front. So we'll go with the young lady first of all.
Hi. Can you hear me?
Yes.
My name is Sachi Trivedi. I'm the founder and CEO of Trident Capital. The question for you, Dr. Summers, is, as a segue to the previous question that you just answered, do you think that kicking out Russia from the SWIFT system was an equivalent of a nuke event in the financial system of the world? And do you think that that event, the weaponization of the dollar, has in some way triggered or accelerated the world's search for alternatives to US dollar and Treasury. So your bio strike may not be today, but 10 years out, if I'm China, I'm thinking very actively about this. If I'm India, I'm thinking very proactively about this.
Look, I think it is a good question. And again, I think that it's the essence of this to be prudent in making judgments. I guess I think the provocation from Russia was so egregious. This wasn't a case of a geopolitical disagreement. This was a case of an invasion of another sovereign nation. And so this wasn't the case of an America that was more excited about a set of human rights issues than other places. It was, again, an invasion that was quite widely condemned. That I would be surprised if it had major effects of the kind you worry about. And I guess I would make as additional points in that regard, certainly since it's happened, the dollar has strengthened substantially rather than weakened, which if there was a kind of long-run prospect of loss of reserve currency status is not what you'd expect to see. Certainly, if we are moving into a world where currencies are going to be used in more geopolitical ways, I don't think that's necessarily going to cause a gravitation towards Chinese assets. Whatever the prospect of non-governmental, IT, technologically based, decentralized assets, whatever plausibility the world attached to that 6 months ago, it's hard to believe that after the events of the last 6 months, those don't appear remote. And my examination of past transitions from reserve currencies would suggest that they are much more symptoms of countries' problems than they are causes of countries' problems. So if one, for example, looks at the loss of the pound's role as a reserve currency, it would be much closer to right to say that Britain had lost its centrality in the world, and then, with some lag, the pound lost its centrality in the global financial system, than it would be to say that the pound was a substantial source of British power, that mismanagement of the pound caused the pound to lose its centrality, and that then weakened Britain's role in the world. So my best guess is that the dollar has a long horizon as in its role at the center of the international financial system, and that whenever that ends, it is more likely to be a symptom of broader developments than it is to be something that has its roots in misguided financial policies. Could that turn out to be wrong if we act in sufficiently misguided ways? Yes, it certainly could, but I would say that I'd be pretty surprised if future historians looked back and saw this conflict with Russia as being, and what was done with respect to SWIFT, as being at the center of some change in the major currency evolution.
We're going to take another question from the floor. If we can just pass the microphone there. Just before we do that, Larry, you mentioned the pound. Obviously, it has been huge volatility and brutalized over the past number of months. On sterling, is it not a long goodbye as a reserve currency, but is it deeply wounded and take a long time for sterling to recover?
I'm sorry, my comment about sterling was a comment about sterling in the 1950s, not about current,
in the past 2
when
months.
the pound was kind of at the center of the global financial system. It was not a comment. It was not a comment about sterling in the context of the last bit of adventures in British financial policy. I don't have a strong view on that. My instincts are that Britain is a little bit like the hospitalized patient that codes, and then they get through the code, and there's a huge sense of relief that they've gotten through the code. But then after a little time, everybody remembers that there is a reason the patient is still in the hospital, which is that they have a serious illness. And I think Britain has some quite profound competitiveness. What is its place in the international economic system after Brexit issues? And the fact that the excesses of the Johnson Trust period appear to be substantially curbed is much better than if they had not been curbed, but it doesn't remove the sense of very substantial challenge ahead of the British government and ahead of British economic policy.
I've taken a deviated tour myself. Let's have a question from the audience. Sir, you are, and your
When
question.
do you expect the Fed to start easing, reversing basically its current tightening policies? If you would pick a quarter or a year, which quarter and which year would you anticipate that?
I think the question was, let me just check. I think the question was, when do you expect the Fed to start easing? And you were hoping to pin me down to a quarter, which you're not going to succeed in doing. I would be surprised if the Fed had finished tightening before the end of the first quarter of this year. And I would be a bit surprised if it was less than 6 months from the time they finished tightening till the time they started easing, unless there was a major shock in which inflation was falling very fast and the economy was really falling out of bed. So that's pointing towards the latter part of next year as a potential target. And given that I'm not quite as convinced as many others about disinflation, it could be longer than that. I mean, just to say a word on the last thing, I tend to think of wage inflation as a kind of super core measure of inflation, that ultimately costs depend on wages. And I read the data, and I pay particular attention to the data coming from the Atlanta Fed, because they follow the same worker year after year, so it's month after month, so it's not distorted by changes in composition. I read that data along with the data on the beverage curve on vacancies relative to unemployment as pointing to very strong wage inflation. And I just don't see a world with 5 or 5.5% wage inflation and acceptable, even on a generous definition, price inflation. And that's why I tend to think that the lags towards a pivot towards reducing inflation are longer than a consensus would have it. But experience suggests that a significant fraction of the time people don't realize we're in recession until 2 or 3 months after people subsequently date the recession as having begun. So it certainly could happen that we wake up and discover that the economy's in a bit of a free fall, and that the Fed then starts moving to cut inflation at a meaningful rate. That would it would surprise me if that happened before late next summer, but it would not amaze me.
I mean, with the data, if there's any other questions out there, put your hands up, please. Join the conversation. Sorry, where to, Rachel? Can we pass the microphone over here?
Yep, I've got a question.
That's fine. Let's get the microphone to you. You've got to stand up, just say your name and pitch your question to Dr. Summers.
I think, hello?
Yes, if you want to stand up, if you've got the microphone.
I'm at the back.
Sorry, there's 2 people on this side of the room. If we can just give the microphone to them.
Yeah? Okay, so I have a question for Dr. Summers. So it's actually a 2-part question. The first part is, whatever happened to transitory? And the second part is, if you can talk about oil, energy, seeing that we're in this region. Thank you very much.
I'm sorry, what was the first question about transitory?
What happened to the word transitory? Could you stand up, please? We just can't see you. We're up here with a lot of light. If you stand up.
I am standing up. I am standing up.
Look, the people who believed it, look, transitory turned out to be wrong. It just turned out to be not right as a description of what was going to happen. And I think it taught an important lesson, which is that it's a mistake to take an overly bottom-up view of inflation. That if you study things component by component, you will tend to gravitate to the components that have gone up in a particular month and may not keep going up. And so you will tend to see inflation as transitory. I think there was rather substantial intellectual dishonesty that went on a year ago when it was completely obvious, given what had happened to market rents and market house prices, and given the way indices were constructed, it was completely obvious that inflation was going to remain high through 2021. And the acolytes of Team Transitory just refused to recognize that and focused on a few specific factors like used cars that supported their argument. So I think the transitory arguments were just very substantially overdone, and that as a general rule, it's a mistake to trust central bankers focusing on specific factors to explain away inflation. That was right in the 1970s when the culprits were Arthur Burns and G. William Miller, and it was right in 2021 and early 2022 when the culprits were current central bankers. And so I think it was quite appropriate to, when Chairman Powell retired the term transitory from his vocabulary, and somewhat overdue. With respect to oil and energy prices, what could be more foolish than a Harvard professor working in Cambridge, Massachusetts, coming to the Middle East and pontificating on the subject of oil prices. So I'm not going to try. I am struck by what feels like a bit of a disjunction between the market, which is backwardated and is suggesting that oil prices are likely to decline over the next year, and a great deal of what I hear from people who talk comfortably about barrels per day and 7 different types of refined product, and are very sophisticated about energy markets, who tend to express a variety of concerns about a variety of things being in short supply and a variety of risks. And I suspect that the reconciliation lies in part in the fact that oil experts focus on supply, and the market is in part focused on demand, and the possibility that if Nouriel's hard landing for the global economy materializes, that will reduce demand substantially and lead to lower prices. And I think in part it reflects something that's quite profound and that I would urge on all of you in a variety of settings, which is that is a very broad statement about the world. I would suggest to you the following: events are 75% bad, trends are 75% good, and the world, including very prominently your profession, my friend, tends to focus very heavily on trends, on events, rather than on trends. And so I think that reinforces a certain tendency towards pessimism. And I think there are some longer-term trends pointing towards some tendency for energy prices to decline. And some of that is what is manifest in the level of markets. But I am surprised by, and I'm hoping, frankly, when I return from the Middle East to the United States, that I will have a keener level of insight into this apparent disjunction, which leaves me a bit puzzled.
Well, certainly within the oil industry, there is this, the House of Biden and the House of Saud is a very fractious relationship, isn't it, in terms of what Jake Sullivan put out on the night that OPEC cut production by 2 million barrels. Let's pivot to politics. You have the midterms, they're passed, and we have the Biden administration taking the Senate, and we have a whole new adventure ahead of us over the next year and a half. How do you look at this situation on the Biden taking the Senate?
Biden holding.
Holding.
The Senate. I was encouraged by the election. I think that the center held. The center held in the sense that most of the extreme election-denying candidates lost badly and performed worse than pollsters expected. The center held in a reading of the Democratic vote. If one looked at many of the most extreme figures on the progressive side, they ran substantially behind where President Biden had run in their districts in the year 2000. So it was not a good election for those on the far left. Even some of those who had been most strident and shrill in denying the results of the year 2020 election conceded the election rapidly and reasonably graciously. The secretaries of state of key states, in almost every case, the election deniers lost, suggesting a healthier infrastructure for the 2024 election. We have a situation of divided government rather than a situation where government is all in one party. So I think in a very broad sense, the center held. In the same month that the center held in the United States, you had a center holding outcome in Brazil, and at the same time, you had that election process be substantially smoother than was expected. I would judge that the restoration of reasonable normality has occurred more rapidly than most people would have expected in Britain 10 weeks ago. And I would judge that the degree of radicalism in Italy has been less than many would have expected. So I think that there's a lot to worry about politically, and I don't think the concerns about populism are by any means behind us. Mm-hmm. But I do think that the system has appeared more resilient and looks more resilient today than any but a substantial optimist would have predicted a couple months ago. And that's something from which we can take considerable satisfaction.
So we have 5.5 minutes left. We've got one question. Larry wants to run through what he wants to be long and short. So the choice is the question or the long and short. You make the call. It's your conference.
Thank you, Manus. Zachary Sefaradi, founder of Dalma Capital. Larry, you mentioned trends, and one trend is certainly pressing the minds of a lot of economists has been the trend of demographics. But there is some debate on both the direction and the strength of impact that this has on natural rates. What do you think is the outlook for demographics and the pressure that this puts on natural rates? Is it profound? And why do you think that this is such a point of disagreement amongst economists?
I think that when historians write the history of the first half of the 21st century in 2300, that the fact that it became the moment when, in essentially all societies that were functioning well and where people were living well, human fertility fell below replacement. And you started to see a basis for shrinking labor force growth and declining population, whether that was urban Iran, whether that was urban India, whether that was North America, Europe, and developed Asia. And all that meant for the human condition. My guess is that that's actually going to be the first story when people write the history in 2300, that story's going to come ahead of even global climate change, which challenge will have been met by technology that will have come ahead of the geopolitical conflicts that will have worked their way through over time. So I'm very much a believer in the importance of demographics. There are two stories about demographics. One story is that less population growth, less investment demand, less need for new housing, less demand for capital, lower interest rates, higher multiples. The other story is more old people, fewer young people, more sellers, fewer buyers, depressed asset prices, lower multiples, higher interest rates as a consequence. And those two forces go in opposite directions. And the reason why economists disagree is that some of them put primary emphasis on the first, and some of them put primary emphasis on the second. Charles Goodhart and his colleagues, for example, put primary emphasis on the second. My own best guess would be that the first is more likely to be the dominant effect, because my read is that, contrary to what certain theories suggest, the tendency for wealth to be decumulated late in life through the sale of assets and their conversion into consumption is in fact less strong than the theory would have it. That if you look, for example, at American data, 80-year-olds are actually on average wealthier than 70-year-olds. And so you don't have the decumulation that's part of the selling story. And therefore, I would put primary emphasis on the factor pointing towards lower interest rates and higher multiples. But there's no reason why it has to work out the same everywhere.
80 and 70, the differential. Let's go for a couple of quick questions. Keep the audience ready for lunch. Long or short? Dollar?
Long, given the fundamental strength of the United States and that trends are running the United States' way.
Long duration?
Short, given higher neutral real rates and there are a lot more integers greater than 2 than there are less than 2. And so when one thinks about possible inflation rates, it's much easier to envision 5% inflation than it is to envision negative 3% inflation. So I doubt that 2 is really a very good best guess. So short.
Long or short China risk?
Long. In general, when a country's language starts to be pervasively studied by American high school students, as Russian was in the 1950s and as Japanese was in the 1980s, it's usually a sign that a country is peaking in terms of its global strength and capacity.
It's flashing here, time's up, which leads me to the last question. Long or short Bitcoin? You can have crypto as a broader technical term. We never quite got there. So long or short cryptocurrencies?
Pass.
We'll leave it there. Dr. Larry Summers, thank you so much for joining us here in Dubai.